Most investors love finding stocks which are trading below their intrinsic value. But do you know the reason that there are so many other factors and ratios which have to be taken into consideration before picking any particular stock, not only the point that they are undervalued? Hi, this is Anirudh Bellari here. Welcome to the 49th video of Your Best Financial Life series. In this video, you will be learning that usually finding valuation wise stocks are easy, but there are more other factors which have to be considered as important before you pick your particular stock before investing. Now remember, this is not a finance or investment related advice. Whatever I am doing in my life, I am going to teach that to you. So it is your wish whether to use it or not. And this video should be considered as an education purpose video. Now see, before moving on to the first point, there are three factors which are extremely crucial. You have your cash flow statement, your profit and loss statement, and your balance sheet. Most important is to know the basics of all of this. Now, what is the meaning of cash flow? The inflow of cash into the business and outflow of cash out of the business. What is balance and balance sheet? Balance sheet is nothing but assets which a company has and liabilities which the companies have to pay, or which takes out money from the company's pocket. That is your balance sheet. Now, what is profit and loss statement? Every quarterly that or every yearly wise, there is this profit and loss statement shown, whereas all the profits which are brought into the company and all the losses which are shown, which eventually all of these three statements have to be shown in the financial statements if it is a public or private limited company. These are certain basics. Now, when you go one step ahead, you come to know that there are deep detailing into all of this and you have particular ratios. So now with aspect to ratios and low valuation, I'll be telling you something. Now see, this is not a promotion basis, but what I use for my life is something called alphaspread.com, which now also I use. Now what is this alphaspread.com? See, this website tells you whether a particular business or a stock before your investments is considered undervalued or not. So you have something like your best case scenario, medium case, and worst case. Now I might have used the incorrect term. It's not medium case, but there is some different type of word there, and I have mentioned it as medium case scenario and worst case scenario. Now what does this mean? Best case scenario is that the particular time at which if you buy the stock, it is considered perfect time according to your price to earnings ratio. Now what is this price to earnings ratio? I will tell you in the following steps. So first you have your best case scenario, whereby if that particular stock is undervalued and if you buy it at that particular time, it is the perfect time you have bought that particular stock or business. So it's like an indication for you whether you're going the right way or not. Then when you move to medium case scenario is where suppose the stock price has not reached the best case scenario, the second best is your medium case scenario, and worst case scenario is the third best. Sometimes say the stock prices come to worst case scenario and then rebound. So that is the third best scenario for you to buy. So these are certain valuation point when it comes to buying. Now in going depth for all of this is where you have the ratios, as I'm mentioning, the price to earnings ratio. Now in simple meaning, what is the meaning of this word price to earning? Now for any investment before you buy, if you go, you will find price to book value, industrial price to earning, and price to earning ratio. Now in simple meaning, for every 1 rupee, how much are you willing to spend for buying that particular business. Now say example, a company's price to earning ratio is mentioned as 10 rupees. Any company, okay? And now the industrial PE, now what is industrial PE? Suppose a random company comes under the technology sector. Now the technology sector, all the particular stocks or businesses, they have a certain price to earnings ratio, which together under that technology sector will come under the industrial price to earning. Now say example, the technology sector, your industrial price to earning is 20 rupees. Now when you compare that particular company to its industrial price to earnings, you will know it is comparatively lesser. That particular company is comparatively lesser than its industrial wise price to earning. Now what does this mean in simple language? For you to pay 10 rupees of that price to earning, for every rupee you pay, it's like telling for every rupee you pay, 10 rupees will leave your pocket. Now say the stock price is, say for example, 150 rupees. For every 1 rupee, you will be shedding out 10 rupees. That is nothing but you are spending 150 rupees for buying one share of that particular business. This is in simple language now. This is one of the indicator. Now, how will you know more in depth? You have something called your price to book value, and that I will be telling you in detail right now. So let's go step by step. See, I may not be the right person to explain all of this, but I can certainly be one of the people who is giving you information and knowledge of what I use, as I mentioned earlier. So see, I could make mistakes as well, so pardon me for that. Okay, let's move on to the second point. Now there is another ratio called price is to earnings is to growth. Now what is this price is to earnings is to growth? It's nothing but your current scenario, the current price of the company right now, whatever amount you pay for buying that stock or that portion of the business, you will be projecting its future growth. Now how will you project it? Obviously you cannot project it. So this ratio will show you what is the growth potential of that company. Now how will you know that growth potential of the company? If the price is to earnings is to growth is lesser than 1, if this ratio is lesser than 1, it is indicated that it is a perfect time for you to actually consider that stock, because in the future, if the company's quarterly results and yearly results, they perform extremely well, and still that particular business is under one price is to earnings is to growth, it means that there is a lot more future potential for it to expand. Now what about companies which are more than price is to earnings is to growth ratio than 1? It is a simple indication telling that the companies have already reached its maximum potential value to an extent. Now there is no saying that you have to follow this rule. It's just an ideology or understanding by you, by which you can take it as a consideration before investing in any particular business or stock when it comes in the stock market. Let's move on to the next most important ratio. Now you have another ratio which is called price is to sales ratio. Now what is this price is to sales ratio? For every 1 rupee you are ready to give to that particular business, is that many amount of times you are going to pay for its sales revenue. It's like telling, I'll give you a very easy example. Now say, for example, there are two shop, one is considered as A shop and one is considered as B shop. Now A shop, buys their goods for say around 1000 rupees, and they're selling their goods to customers at say 1100 rupee. So the profit, I mean the sales which they are going to get is going to be 100 rupees. How is it 100 rupees? They bought the goods at 1000 rupees and they're selling. Their sales is coming in from 1100 rupees. And who is going to give all this? The customer. Now 100 rupees which comes is the sales revenue. Now what is revenue? Revenue is just the normal amount of money which comes. Now what is this normal amount of money? It is the money where you do not subtract your main tax, profit and all of that. It is just the money which comes in after you. That's why it's called revenue. When you subtract all your operating expenses and you have all your, say, your tax, amortization, depreciation and all these terms, what is left with you is called your net profit, is what the business will take home. But what eventually comes into the business is called revenue. Now this company, per customer they are getting 100 rupees profit, whereas the same B shop, they are buying goods at 1000 rupees and they are selling their goods at 2000 rupees. As a result, they are making 1000 rupees of sales revenue per customer. Now when you see, for any business, this is a shop type example, for any business, when you have to consider buying that particular stock when it comes to investments, and when you see your price to sales ratio, you must be in charge. I mean, you must also think, for every rupee or price that you are willing to pay for that company, you are going to pay this much amount of money. So the higher the price to sales ratio, it eventually tells that the business is getting in a lot more revenue compared to its sales. Not sales, because of the sales it gets its revenue. So what does this mean? It means there could be a high profitability when it comes to B shop compared to the A shop. So like these decisions can be seen and also taken into consideration. Let's move on to the third point. Now there is something called your price to book value. Now what is this price to book value? See, price to book value is nothing but for the price you are wanting to get that business, how much are the investors paying for the total assets. Now book value is nothing but the assets in the business. If I'm not wrong, it is assets in the business. So these are some considerations. Now you have even your earnings before interest, tax, dividend, amortization and enterprise value. This is nothing but when any investor is willing to buy or purchase a particular company, how much they are willing to pay for that company, and if they buy that company, what is the net worth of the company and the net assets and net debt as well. Now see, if you are a viewer, you would have seen that I might not have explained these points that much in detail. So see, remember, I myself am at a learning phase here. So whatever I'm telling you right now, as I've mentioned, I too am in the learning process. So if you see, I will keep making videos like this which have even more detail. Now see, right now I've just mentioned 1 or 2 points for the above statements. But in future coming videos, you will understand how much more depth is required when, if at all, you have to take any investment related decision. This is what I do for myself, and I'm telling once again, you may choose to do it, you may not choose to do it. Now see, it's not that what is important over here. Now there's something called EPS, earnings, Earnings per share, yes, as I recall. Now, what is earnings per share? For every price that goes up, what is the earnings that the company has got in that particular quarter or yearly basis? Now, if you notice a trend whereby earnings per share is at the continuous not output, your earnings per share is continuously growing with time, and still the company is not doing well. And if you see that the company is performing at a very good level, its net profit, operating profit margins are going at a very rapid pace, going as in increasing at a rapid pace because the company is doing good business. And still, the price of that particular business or stock is not showing compared to the increased growth of your EPS or your operating profit margins, then it is only about time when the company will eventually start doing well. Now, see, there are more factors as I mentioned. You have your cash flow statements, your profit and loss, your balance sheet. Now, when you go through everything, you will come to know the net assets, your debt to equity ratios. So, there are a lot of ratios which you need to see. And see, for a normal person who doesn't understand all of this, in today's day, with the internet, it's more or less easy for you to learn. And videos like these, it's not that somebody is telling you, like I mentioned, PEG ratio, that is prices to earnings to growth, has to be less than 1 and all that for a good consideration for buying that company. All this you can see through internet as well. But see, every video is like a learning process for you as well, for me. So with this note, I would thank you so much for watching this video till the end. If you did get value, at least to an extent, I know initially I might not have told this concept in a much better value, but at least your awareness level would have risen to a level which has given you more understanding and depth about what you can take into considerations while seeing in before investing in the business. And I've not written here, you have your earnings per share along with your operating profit margins percentage, which is very important to understand how is the business performing internally. As a result, the numbers will be shown in their particular profit and loss statements. So as I mentioned, thank you so much again for watching this video till the end. It gives me immense pleasure to stand here and to create videos like this for you every Wednesday and Sunday. Thank you so much once again.